Good morning, friends. So, yesterday's class, we are doing the last link in this chapter, dividend policy, namely buyback. Stop talking, please. Few discussions I'll make regarding this buyback. Do one more examination problem in buyback of shares. One small model called as Linter's model is left out. We'll complete that and conclude the chapter dividend policy. Then we'll start with the next chapter, portfolio management or portfolio theories. A long chapter, a big chapter, but very important from examination viewpoint. Please. The concepts we study in this portfolio theories will be applicable in other chapters also. In equity valuation, we may use this particular concept, or in futures, there is an area in derivatives called as futures. Also, this portfolio theory can be used, like concept of beta, etc. Even in capital budgeting, Hiller's model, the concept may be used. So, it is a very important concept or important chapter. And in one of the attempts, around 20 marks was asked from this portfolio management itself. Purely from this chapter, around 20 marks has been asked in the exam. Surely we can expect around 10 to 15 marks from this chapter in the examination. One of the very important and main chapters in the syllabus. Once we complete the portfolio, then we'll go for capital budgeting, advanced concepts like leasing, capital budgeting under uncertainty, and then move back to the derivative section later. So now let us summarize what is done in the dividend policy and what is done in the buyback before I proceed further. Please. We have seen that for making investment we require finance. Business is all about raising finance and then making investment, generating returns and servicing the finance providers. So the profits earned will be obviously used to service the finance providers. In case of debt, they clearly say what they want and the money will be paid to them. For equity, it is not a compulsion that profit should be given back to them. It is a choice the company is having. In such a case, company may distribute or may not distribute the profit. Such a decision we call as the dividend policy. So whether the investment decision, financing decision, dividend decision affects the share price was the issue. Financing decision affects the share valuation, say by cost of capital. Investment decision affects share valuation through IRR. And whether the final dividend decision will be affecting or not is the issue. Yes, it will affect the valuation is what theories of relevance said. No, it will not affect is what theories of irrelevance said. There are two theories of relevance, Walter and Gordon, and there is a theory of irrelevance, Modigliani-Miller approach. So we study the following: Walter's model, Gordon model, Modigliani-Miller approach, and residual dividend policy also has been discussed. What Walter says is that if the R is greater than KE, what you can invest is giving a return of R. What they want is KE. If R is greater than KE, retain and invest. If R is less than KE, distribute as dividend. He uses a share valuation formula. P0 is equal to D plus R by KE into E minus D whole divided by KE. Gordon says that just because you have a good investment, don't try to retain so much, because more retention will create more risk in the mind of the shareholders. They may increase their KE. The advantage of retention is growth, but the disadvantage of retention is the increased risk they perceive for a promised capital gain rather than a current dividend income. In such a case, Gordon says the best payout should be where the share price is highest. He valued the share using the formula P0 is equal to E into 1 minus P divided by KE minus DR. Modigliani-Miller says that Just because you are declaring dividend or not declaring dividend, your investment will not stop. If the investment is good, you will still make it, whether you make a dividend payment or do not make the dividend payment. If you pay dividend, then we can raise fresh issue and make the investment. So what MM says that if a company pays dividend, from the shareholder's point of view, two things will happen. He receives dividend and the share price drops. Since he receives dividend and share price drops, if you total both, the wealth will be same. For the company, it is paying dividend, money goes out, it raises the same money once again through new issue. The money going out and money coming in that case for a company also, the value is not going to change. So with dividend or without dividend, the value is going to be same, was Modigliani Miller said. And he proved his hypothesis using the formula NP0 is equal to P1 into N plus M minus I plus E whole divided by 1 plus KE. Then we discuss about the residual dividend policy. Residual dividend policy communicates two things. Number one, company should have a consistency in their capital structure. They should not keep on tinkering the capital structure. Then they will be losing the trust of the investors. Company having a constant capital structure, they know what financial risk to expect from a given project. In such a case, what they say is capital structure should be maintained. Any new project, you should finance in the same debt-equity ratio what the existing projects are getting financed. And even if you say equity financing, the first way to get the money from equity shareholder is use retained earnings and then only go for the public issue or through new issue, because retained earnings has got no other cost except for the KE. But when you go for the public issue, apart from their expectation, you have to incur flotation cost and other related cost. This is what is the residual dividend policies communication. All models, one thing is sure, if I have a surplus cash, what I should do? Distribute. Don't keep the surplus cash in hand. Don't sit on the cash, because then you are earning zero return for a KE cost of capital. NPV of that cash will become negative. Surplus cash should be distributed. Distributing cash to the shareholder is as good as reinvesting. Yes or no? When I invest in a project, I invest at R. When I distribute, I invest at KE, is what one should be understanding, which was explained in the previous class. These are all the issues we discussed, and incidentally, we also discussed about the rights issue, how to calculate the X rights price, and what is the value of the rights. When you have been given the written information, when you have not been given the written information, all these issues have been covered in this chapter, dividend policy. We did one case study type of problem where all this were mixed and applied in a sensible manner. Can I proceed or not? Now, the last issue which we are discussing is what? Buyback. We almost completed this particular buyback sum. Just one or two issues I wanted to discuss quickly and do one more buyback problem from the examination and then complete this chapter, dividend policy. Can I proceed or not? Now, see, yesterday's class, towards the end, we discussed buyback, right? You are all in a hurry to leave. Did you all listen? Yes, sir. Okay, now let me summarize and then proceed further, please. See, when a company is having a surplus cash, it has to give to the shareholders. Above that, no dispute. There are two ways in which the cash can be returned to the shareholder. One is by way of dividend distribution, and second is by way of buyback. In buyback, I give the cash and purchase the shares. It is as good as company investing the money in its own share, is what we call as the buyback. When buyback happens, I am the company, I am having the surplus cash. Suppose in this problem, if you remember, I am having 50,000 rupees as surplus cash, 25 rupees is the market price of the share. I am buying the shares from the public. How many shares I buy? 2,000 shares I buy. Correct? The number of shares was 1 lakh. I bought back how many shares here? 2,000 shares. Company has got two options. When it buys back 2,000 shares, the 2,000 shares can be cancelled. It can be what? Cancelled. From issued capital also it goes and cash also goes out. Everybody following or not? The other way of doing it is, the company can buy back the 2000 shares. It need not cancel. It can keep it as a treasury shares. Can keep it as what? A treasury share. So that on a future date, the share can be what? Reissued. When the share price improves, is the other aspect the company may be having. Everybody yes or no? In case of treasury shares, the liability side issued capital will not get cancelled. It remains what? Same. Instead of cash, it will be having the investment in what? Treasury shares in the balance sheet. Everybody are you following order? So that means if you see companies issued capital, there are two parts of company issued capital. One is treasury shares, another is what? Outstanding shares. Okay. Treasury shares means in that issued capital, company itself is what? Shareholder. And outstanding shares means other than company, all the other outsiders are shareholders. The rights like dividend, rights issue, or it is also what? Other rights like right to voting, everything will be only for the outstanding shares, and nothing will be there for the treasury shares. Instead of cancelling, they keep it as what? Investment. That's the only change. Everybody following or not? Now, next we saw that distribution is made. 50,000 cash is what? Distributed. Don't think I'm repeating it. Let us have one discussion to have a continuity. Okay. See, if you look at that sum, the company is at present having how many shares? Everybody. Slide la irukka, you have also revised it. I hope you have revised it. Okay. Company has how many shares here? 1 lakh shares. The 1 lakh share today is trading in the market at how much a base? That means the company's current wealth is how much? 25 lakh. It is earning how much EPS? That is, its earnings is how much a base? 3 lakh rupees. And out of the 25 lakhs wealth, what is surplus wealth? 50,000. These are all the details given in the balance sheet. Everybody yes or no? Now, what I am saying is a book value balance sheet, market value, market value. In a market value balance sheet, this is my position. I have a surplus cash. How much a base? 50,000. I have assets worth how much? 24 lakh 50,000. And the company equity value is how much here? 25 lakhs is the value of the company's equity. Am I right or not? No. This 24 lakh 50,000 is the total of all the fixed assets book value. True or false? What is 24 lakh 50,000? All the assets are going to generate some profit or not? The present value of the future profit is 24 lakh 50,000. Respond yes or no? In other words, we had 3 rupees EPS, 3 lakh rupees profit or not. The present value of the infinite years 3 lakh profit is going to be the value of this 24 lakh 50,000. Respond yes or no? Now, my question is, first of all, when I don't do anything, today value of 1 rupee cash is what? 1 rupee. Yes or no? Why today value of 1 rupee cash is 1 rupee? Because with that 1 rupee, I can do what I want. Yes or no? Right or not? Now, suppose I can do what I want with this cash, but I don't do anything. What much the cash? The value decreases. That is 50,000 cash. I am showing you. See, 50,000 rupees notes are there. You say 50,000. Yes or no? In the pocket. Then what happens here? You get disappointed. So then you ask, what are you going to do? And next question, what I want to ask is, what are you going to do with that cash? I said, I am going to keep it in my pocket. Then what do you say? Yeah, I reduce the value because today it is 50,000. It is having a cost of capital, but no IRR. So what happens? IRR is 0% and say KE is 14%. In that case, the 50,000 cash NPV gradually reduces. Yes or no? And I am investing 50,000 by putting into my pocket. You are investing with me 50,000 or not? In that case, you will never accept if I return you back 50,000 after 1 year. Yes or no? That means the value of the cash reduces. To avoid the reduction, what I should do? I should give the cash back to you. Are you following or not? When I give the cash back to you, what happens to my wealth here? 25 lakhs or 24 lakh 50 or 24 lakh 50,000. It becomes the original wealth. Yes or no? No. When I declare this 50,000 as what? Dividend, in that case, 24 lakh 50,000 will be shared by how many shares? 1 lakh shares. The share price will be same or decreases or decreases. It becomes how much here? 24.5. Point number 1. Yes or no? Okay. Now, share price drop by 24.5 or not? You are happier, unhappier? You are not worried about, because your investment will become how much? 24.5. I am telling a personal balance sheet. In a personal balance sheet, my company share value become how much? 24.5. But you got a cash for what? 50 paise. That means once again your wealth has become what? 25 rupees. No change in your wealth. Right or not? Okay. The other option is to give you the money and get back the shares. It is called as what? Buyback. In case of buyback, what happens to share price? Drops to 24.5, remains same. The share price remains what? Same. What happens is, when I give you that money 50,000, from you I repurchase how many shares? 2,000 shares. Now, this 24,50,000 well is not going to be shared by 1 lakh shares. It will be shared by how many shares? 98,000 shares, leaving the share price what? Unchanged. Now, for you, the dividend and buyback are same. The very simple reason. In case of dividend, you receive cash and the share price decreases. In case of buyback, your number of shares what? Reduces. But the share price is what? Maintained. I prove through the next slide. In all cases, whether you receive dividend, whether you buy back, or even if you don't buy back, in all the cases, the share price remains what? Same, is what I have discussed in the next part. Okay, this is the last part of the question. Now, here, pay dividend and then buy back the shares. Okay, now, wealth before. Suppose I am holding 10 shares. When I hold 10 shares, what is the wealth before the dividend or buyback? 2250 rupees. Now, suppose dividend is declared. What happens to my 10 share value? Becomes what? 24.5, 245. And what is going to buy the cash received here? 5 rupees. My wealth still remain what? 250. Suppose buyback happens when 2 shares are sold. That is, don't think that like rights issue, buyback is having a ratio. Not like that. Anybody can sell the share to what? Company. In case of buyback shares, 8 shares I am going to hold and 2 shares I am going to sell to the company. What is the value of 8 shares? 200. What is the cash I receive selling 2 shares? 50. What is the wealth? 250. Suppose I am going to sell all the 10 shares. In that case, what is the wealth I am going to have it? 10 shares into 25, 250 cash. I am not going to do anything. I still hold what? 10 shares worth 25. It becomes how much? 250 rupees. Everybody, are you following or not? That means, whether I declare dividend or whether I what? Buy back, my wealth is protected. Yes or no? Wealth is same or different? Same. If I do nothing, when the company does not do anything, wealth will reduce because 50,000 cash will not be 50,000, will become what? 45,000 or 44,000 due to negative NPV of the cash. Are you following what I am saying? So, if the company distributes, the wealth is protected, the distribution can happen either through what? Buyback or through dividend. Technically, finance angle, there is no difference between a buyback or what? Dividend is point number 1 I wanted to communicate. Everybody following or not? Now, theoretically, I am again using the word theoretically or technically, there is no difference between buyback or what? Dividend. The company money is what? Going out. That's the ultimate thing. Just because the company money goes out, the value of the company will not fall because it is only distributing the surplus money, not selling an asset and what? Giving the money. The asset continues to earn the same profit. The company continues to have what? The same value. Only thing is the money is kept idle only. It will be affecting the company. Are you following or not? Okay, now, next. But there are preferences in the market. Sometimes company may prefer to distribute using buyback and sometimes some company may prefer to distribute using dividends. Okay, there are situations where buyback may be liked or what? Dividend may be liked. I want to only discuss those angles now and then I'll just give you the notes about them before you go for the next stage. Can I present or not? Now, at present one thing we know, buyback or dividend, both are what? Equally good only. Both doesn't affect the shareholders value differently. But market is not about always perfection. Market is imperfect, right or not? Some cases buyback may be good and some cases what? Dividend may be good. Now, let me tell you when buyback is good or why companies sometimes go for a buyback route of distributing money and not the dividend route of distributing money. We have 3 points to discuss in this regard. Okay, number 1. Point number 1 is the tax benefit one was getting. I use the word what? Was getting. Till recently one was getting through what? The buyback route. Okay, simple. Take the Indian context itself. Company declares dividend. Should it pay tax? Yes. What it should pay? It should pay dividend distribution tax. On the distribution, they levy what? Tax. So in that case, the company has to pay dividend distribution tax on the money declared as dividend. Okay. If they want to, simple calculation, don't say accuracy. If they want to distribute 100 rupees, 10 rupees goes by what? Say 16 rupees goes by way of what? Tax. And balance 84 rupees only reaches the shareholders. And so there is a tax on the distribution of dividend. So dividend has got a dividend distribution tax. Are you following? Next, when buyback happens, forget the current scenario, just even 6 months back, when buyback happens, we asked the company to pay any distribution tax? No. The company did not pay the distribution tax. It is treated as a capital gain. Treated as what? A capital gain, because the shareholder earlier purchased the share. Now it is what? Selling the share. Instead of selling the share to other parties, he sells the share to what? The company itself. That's the only difference. So it can be treated as what? Capital gain. Okay. There also how the buyback happens differs, whether the company is going into stock market through stock exchange making the buyback, or whether the buyback is made directly through stock exchange, means the different capital gains tax, and the private transfer directly to demat account of company means what? It's going to have a different capital gains tax. But one thing is, buyback will be having what? A capital gains tax. Everybody following or not? So, dividend has got dividend distribution tax, which the company has to pay, and buyback will be having what? Capital gains tax. Respond yes or no? You may say, sir, both are suffering what? Taxes only. Stock exchange through that even capital gains tax is 15%. Respond yes or no? So, what is so great? Both are almost what? Same. 16% or 15%. It was a position, but for some persons, this is advantageous. This is what? Advantageous. Suppose foreign investors are there who root their money through what? The tax exempt countries for capital gains like Singapore, Mauritius, etc. Okay, what they do is they invest from that country to what? The companies in India. The company has earned profit. Now they have to distribute. Yes or no? If the company wants to distribute the money to them as dividend, they have to pay what? Because the tax is not a non-resident, it is on what? A resident company. They have to pay the CDT, the dividend distribution tax. Respond yes or no? But if it is given as what? Buyback, then the taxability will be in the hands of what? The foreign investor. Will be in the hands of what? Foreign investor. Suppose there is a treaty between India and that country where the amount is allowed to be charged to tax in that country. That means foreign the tax incidence arises what? The place from where he invests. Are you following not? Suppose that country has exempted what? Capital gains. In that case, he will escape from the capital gains tax. Are you following? So they felt that this is one of the way invest, the money can be what? Siphoned out of the country. The main reason for dividend distribution tax, I already said, is to promote what? Is to promote what? The investment. It is a penalty for distribution, yes or no? But now, even if I distribute to the fellow countryman, at least I will invest in what? Another, you say, company in the country, investment can be promoted, yeah? But here the money is getting what? Out of the country, even without suffering the tax. In that case, so what they did is, they amended the Income Tax Act, where the distribution of money through what? Buyback also is subjected to what? The tax. So they are having a 20% tax plus what? Applicable surcharge as a buyback distribution tax. Now, are you following not? It is very simple. Suppose I am selling at 30 rupees. I bought the share here at how much rupees? Yeah, 10 rupees. On this 20 rupees amount, who has to pay tax? The company, not shareholder. Who has to pay the tax? Company has to pay tax. How when they distribute dividend, they have to pay the CDT. Like that on the buyback distribution, all they have to pay what? Tax. The tax to be paid is 20% is levied. Apart from what? The surcharge. Everybody following not? Now, in this case, who is taxed? The shareholder or the company? Company. Actually, shareholder should be exempted from the capital gains tax. Appropriate amendment has been made. Everybody following not? Now. So, this is the tax benefit. Not now I am saying, earlier buyback is having, yes or no? Dividend CDT is that buyback does not have what? CDT. Through a tax planning, through buyback, people are avoiding what? Tax, or people are getting a tax exemption or tax benefit is one of the earlier advantages of buyback. Now we cannot say that as advantage. Now which is better? Dividend or buyback? At least dividend how much percent? 16.995 some percent is there. Buyback we have to pay what? 20 plus the surcharge should be paid. So now it is to discourage buyback and to encourage what? Dividend distribution, and more to encourage retention. This has been brought into picture. Everybody following not now. So this is the first benefit you should be saying. But now that benefit is what? Not that. But the subject is not Indian based, it is what? Global. These benefits can be there outside India, right or not? So buyback has got a tax benefit compared to dividend. Point number 1. Respond yes or no? Now, next is point number 2. Apart from this, leave tax and all, business sense itself, buyback has got certain distinct advantages. Okay. Now let us see the advantage one by one. First of all, when I buy back the share, the number of shares will increase or reduce. Number of shares will increase or reduce? Reduce. When number of shares reduces, what happens is the supply of the share in the stock market is less. Correct? 1 lakh shares were earlier trading in the stock exchange. Yeah? Now how many shares are trading? 90,000 only. The share is also like any other commodity. Don't think anything rate. Any market, something is bought and sold. That's all. Yes or no? Now I am curbing the supply of the share. Yes or no? That means my company share, lesser money as a shares only is what? Trading. That means they are saying I am reducing my market float. I am reducing my what? Market float. The float means how many shares are floating in the market. I am reducing what? The market float. When the market float for a share reduces, even if there is a small increase in demand, the share price increase will be very much higher. Following what I am saying? That is, people want to buy this share. Suppose people want to buy this share. Next year the company performs exceedingly well. People want to buy this share. Earlier, people had some luxury because 1 lakh shares available. Supply is good. Yes or no? But now, there is only what? Limited supply. The demand is what? Great means the volatility of the share price becomes what? Much more higher when the supply is curbed. Are you following or not? So now company feels that if it is buying back the shares, one of the advantages, the supply of shares can be what? Curbed, and this is not finance, this is what? The marketing. Are you following? So the supply of the share is what? Curbed, thereby I can reduce what? Market float and increase the share price even for a small increase in demand of the company share. Here the second advantage of buyback, which dividend cannot give you. Response yes or no. So the next advantage buyback is what? Buybacks decreases what? Supply of shares, thereby can increase the price. When there is a demand for the share, that is going to increase. Everybody following or not? Now, next. Point 3. Buyback communicates something to the shareholders. A astute market investor can understand something from buyback. What does it communicate? Okay, very simply, I am a person who wants to invest, 2 shares are available. One share is trading at 90, another share is trading at what? 80. I can say equally worth the company only. Yeah, 2 companies are that equally good. Okay, equally good. I feel both should have what? Same value in my opinion. Just give me answer. But one company share is trading at 90, another company share is trading at what? 80. Which company shall be buying at 90 rupees or 80 rupees? That is, you always like to buy undervalued company. When I like to buy an undervalued company, it means the company is really having what? More value. I communicate through my action. That is, when I buy a share, suppose everybody is buying a Axis Bank share. For example, everybody is buying what? Axis Bank share. What it communicates here? People feel that Axis Bank is worth more than what is trading in the stock market. Right or not? That is what any buying action communicates. Everybody is selling a share. What does it mean? The share is overvalued. Let me book profit and get out. Are you following what I am saying? So, whenever market is buying something, it means that it is having a value more than what is really worth. So, always a buying action communicates an undervaluation. Are you following or not? No. When a company buys back its own shares, buys back its what? Own shares. The board of directors in the board meeting announce buyback. They are announcing what? Buyback of their own shares. Then they will announce when they feel the share is overvalued or undervalued. Undervalued, because they feel that their company is worth more, and because they know the insider information. What the board knows, you will not be knowing. You and I may not be knowing about the MTHK worth. What the board is knowing, it may be worth more or worth less. We don't know, but board has got what? All the insane women, they know about the projects, they know about the response to what various activities and so on. Board is in a better position to know about a company than outsider. So no, when a board announces a buyback, you should know that board is believing that the company share price is what? Undervalued. So when the share is undervalued, let me buy it what? Lower price and avoid my cost of capital cheaper. Are you following what I am saying? That is why the company goes for what? Buyback. Whenever the shares are undervalued only, they like to go for what? Buyback. Nobody buys back a share which is overvalued. Yeah, 50 rupees share trading for 500 rupees. Now, no fool company will pay what? 500 rupees because they investing the shareholders' money at a wrong place. So they would have invested what? In some other company giving a more return. Are you following what I am saying? So when a company buys back, what is the indication, signal they give to the market? The board feels that the company is what? Undervalued. Hence they are going for a buyback. Yes or no? when this news comes, buyback price is fixed. That is why they want buying at the undervalued company. But once this news goes out, what the public feels that, see, the board itself is what? Buying this company share means I should also what? Buy the same company share. Board buying the company shares. Yeah. Suppose I buy my share means I'm having confidence in my share or not. Then he said, Raju Gopal itself is what? Buying a share. Let me what? Go and buy a share. Yeah, market sentiment will follow that or not. So generally after buyback, sometimes the demand for the share what? Increases. And two things happen here. Supply is decreased, demand is increased. They manage to what? Increase the share price quickly to a higher end. Are you found what I'm saying? It is one of the way in which company can trigger what? Increase in share price. Everybody following or not? All this I cannot do with the dividend. All I can do with what? Dividend. These things can be done only with what? A buyback of share. Everybody following or not? So now tell me, three advantage of buyback. Third is what? It is communicating about what? Communicating about undervaluation. It communicates about what? Undervaluation. Okay. First is tax benefit. Capital gains may be exempt for somebody, but DDT is what? Compulsory. Some people may use a buyback, mainly foreign investors, as a tax avoidance scheme. Now it is not possible. This is a latest position. Position will always change, but fact can remain. Yes or no? Next. Second case, buyback decreases what? Share supply, thereby can increase the demand for the share as well as the price. Third is buyback communicates that board itself feels the share is what? Undervalued, which triggers others also to demand for the same company share. And with the decreased supply and the undervaluation being communicated, naturally the share price has to increase more. Always my aim is to increase the wealth, right or not? This wealth can be increased in this way. An undervalued company share can be corrected through what? A buyback issue. Respond, are you following or not? Now, the fourth advantage of buyback is choice. It's very important. Fourth advantage is what? Choice. See, dividend is forced on you. When you declare 50 rupees dividend, every shareholder should receive the dividend. Whether he likes or not, he has to pay CDT. He has to pay means what? Company pays, he is also paying. For me, company he has same only. Because for him only I am running the company. Now, in case of dividend, every shareholder has to share the brunt of corporate dividend tax. Even though he may not want money, he want to what? Reinvest money. Still he has to compulsorily what? Receive dividend. After foregoing 16% as corporate dividend tax. Yes or no? So dividend distribution, you are thrusting the receipt on the shareholder. Yes or no? Buyback is not same. If you want, you buy back. If you don't want what? You leave the money here. The money is with the company only. Are you following? Out of 1 lakh share, 2,000 shares is there or not? Don't think that every shareholder 2% buyback will take place. Not at all. Yeah? 2,000 share company offer to buy back. Okay. One shareholder himself can go and buy back what? 2,000. Another shareholder may not want buy back at all. Everybody following not? In that case, whether to buy back or not is your choice. Are you following what I am saying? So you can postpone your tax liability to a later stage through a capital appreciation on a later there rather than paying a dividend tax today itself. Are you following what I am saying? So dividend does not give you a choice to receive or not to receive. Buyback gives you what? Choice to receive or not to receive. Are you following what I am saying? This is yet an advantage of buyback. And one more thing. Suppose I am a person who don't know how to invest. Who don't know what? How to invest. In that case, what happens? If you give me dividend, I'll be searching here and there and put in my savings bank account. But in case of buyback, I suppose I don't know how to invest, I will not buy back the share. Let it be with what? Company. Those who know how to invest, let them take it. Yes or no? Normally, who takes buyback offers? Institutional investors. Okay, a mutual fund. Others may what? Buy the back shares because they know how to invest. As a retail investor, I don't want to have a headache of investing once again what? Dividend. In that case, it gives a choice to shareholder whether to receive money or not receive money. The choice is not available when declared as dividend. Are you following? All are advantage of dividend over, say, buyback over what? Dividends. Everybody, are you following or not? And the disadvantage now is obviously buyback has to suffer how much? 20%. Dividend only how much percent? 16%. That is a alternative thing. Everybody following or not? So with this, we complete this particular area called as buyback. One examination problem is also there. We'll do that and then wind up this particular chapter. Can I proceed or not? Now, write down first notes. Notes. Okay, write down. This problem over, right or not? Right on. Point number 1. When company has, please, when company has surplus cash, when company has surplus cash, when company has surplus cash, it should not retain it. When company has surplus cash, it should not retain it, but should distribute it back to, it should not retain it, but should distribute it back to, but should distribute it back to shareholders, but should distribute it back to shareholders. Point number 2. The distribution can be done in 2 ways. Point number 2. The distribution can be done in 2 ways. The distribution can be done in 2 ways. Branch it into 2. By way of, first branch is by way of dividends. First branch by way of dividends. Second branch by way of share repurchase. By way of dividends. Second branch by way of share repurchase. Can I proceed or not? Next. Point number 2 or 3? 3. Whether we distribute as dividend, whether we distribute as dividend or as share repurchase, whether we distribute as dividend or as share repurchase, it will not have any impact on, it will not have any impact on the shareholders' wealth. It will not have any impact on the shareholders' wealth. As seen above, it will not have any impact on shareholders' wealth as seen above. So I don't want to elaborate this. The numbers are self-explanatory. Everybody yes or no? Everywhere the money is only how much? 250. It will not have any impact on shareholders' wealth as seen above. Hence, continue, hence, dividend distribution or buyback. Hence, dividend distribution or buyback theoretically are, hence dividend distribution or buyback theoretically are equally good. Hence, dividend distribution or buyback theoretically are equally good. Theoretically are equally good. Can I proceed? Next, point number 3 or 4 or 5? Point number 4. However, sometimes buyback has, the following advantages. However, buyback has sometimes the following advantages. Buyback has sometimes the following advantages. Point number 1. Point number 1, tax benefit. Point number 1, tax benefit. Under that, right, when dividend is paid, company needs to pay, when dividend is paid, company needs to pay what? CDT on it. When dividend is paid, company needs to pay CDT on it. However, in case of buyback, continue, however, in case of buyback, it will be taxed as, however, in case of buyback, it will be taxed as, under what head it will be taxed here? Capital gains. However, under buyback, it will be taxed as capital gains. in the hands of shareholders. However, it will be taxed as capital gains in the hands of shareholders. In case of foreign investors, they can get exemption. In case of foreign investor, they can get exemption from this capital gains tax. In case of foreign investor, they can get exemption from this capital gain tax, through tax treaties. They can get exemption from this capital gains tax through tax treaties. I am summarizing and dictating. You are able to follow now through tax treaties. Hence, buyback may be attractive for them. However, full stop. However, through the recent amendment, the company has to pay. The company has to pay distribution tax. The company has to pay distribution tax at 20%. The company has to pay distribution tax at 20% on this buyback also. The company has to pay distribution tax at 20% on this buyback also. Everybody, are you following or not on this buyback also? Now, point number 1 or 2? 2. Point number 2. Buyback reduces. Please don't talk. Buyback reduces the number of shares floating in the market. Buyback reduces the number of shares floating in the market. That is, supply reduced. Buyback reduces number of shares floating in the market. That is, supply reduced. Due to reduced supply, and increased demand, the share price will increase. Due to reduced supply and increased demand, the share price will reduce. So the share price will increase. Okay, due to reduced supply and increased demand, the share price will increase. Tell me, what is the objective of running my company? To increase. Always, any corporate, only aim is to increase what? Share price. Somehow I should do that. Yes or no? Will increase my what? Share price. Point number 2 over. Yes or no? Point number 3. Investors generally buy undervalued shares. Full stop. When the board decides to buy back its own shares, it communicates to the public that the share is what? Undervalued. It communicates to the public that the share is undervalued. Due to this, the public demand for the share increases. Due to this, the public demand for the share increases, and also due to reduced supply, previous point dictated now, and also due to reduced supply, the share price increases, and also due to reduced supply, the share price increases, and also due to reduced supply, the share price increases. Point 3 or 4? 4. Dividend makes the shareholder compulsorily receive the money. Dividend makes the shareholder compulsorily receive the money. Dividend makes the shareholder compulsorily receive the money. But buyback option is a choice. But buyback option is a choice. But buyback option is a choice where the shareholder can receive money, by selling the shares, where the shareholder receives money by selling the shares, or leave the money with the company, by not going for buyback, or leave the money with the company by not going for buyback, or leave the money with the company by not going for buyback, Everybody following or not? Now, one more point I missed out. I'll tell and dictate. These are the 4 points discussed about advantage of buyback or not. Now, one last point I say. See, don't talk. In big companies, there are 2 types of shareholders. Shareholders can be of what? 2 types. Not legally, but operationally, there can be 2 types of shareholders. One type of shareholder are those shareholders who are engaged in running the business of the company. I will find out that. For example, Infosys, Narayan Murthy also is one shareholder. He is directly engaged in what? Running the business of the company, and they are operational. Are you following what I am saying? So, that's one type of shareholder. Okay. Other type of shareholder, the word used is activist shareholder. Whom here? Activist shareholder. They always prevent company from taking decisions. That is, they always demand their rights. They always suspect that the management doing what? Something against them. Activists now. We are having Anna Hazare, Arvind Kejriwal, all activists are not there. So they don't run that. Now, Arvind Kejriwal different. Yeah? Look. I am not criticizing, I am only saying example. Okay. So Anna Hazare will not run what? Country, but always try to question. I don't say questioning wrong. Yeah, I am only saying the position is or no. Times now, Arnav Goswami is there, yeah. He does not go and make cabinet decisions, but he always want he prevents decisions from being made by always questioning decisions. I will find another. Now, see, more activist shareholder is there means, every time activism is good as well as what bad, it may cripple decision making process. I will find another. Now, I am not speaking politics. Okay, politics different. I am speaking about what company. I have to give some appropriate example or not. I am giving. Okay, now. See, when there are more activist shareholder, what happens is, activism more means the company is real, that is person or real shareholder who started the company, wants to run the company, may sometimes feel crippled about decision making. Now, they want to get freedom now, they have to buy their shares, yes or no? Now, what buyback can do is, company is having surplus cash, is having what? Surplus cash. He cannot make investment elsewhere, at least by those shareholders. I know what I am saying? At least buyback, that is if they are willing to sell. I am saying they are willing to sell. At least what? Buyback from those shareholders. They may be unhappy with you. You are unhappy with them. So no. Somehow you have to escape. Right or not? In that case, they also want to escape from you. You also want to what? Escape from that. What you can do? Put the money to them, get their share back, and then what? The company can run the business because now they become more majority. So no. when those 2000 shares are active shareholder shares, what happens is, then your proportion is going to what? Further increase. The proportion of the promoter or the proportion of what? Real persons running the company will be what? Further increasing, thereby giving them some freedom or leeway for what? Decision making process. Everybody following on? These are all the practical ways why the buyback can be used. Last thing, company wants to maintain debt equity ratio. Capital structure is there or not? For long, it is having 2:1 capital structure. 2:1 means what? 2 debt, 1 equity. Now they want to change the capital structure to 1:1. They want to increase more risk. They want to have what? More debentures. Enna right or not? 2:1 capital structure. They want to make it as what? 1:1. Enna purinjudha? In that case, one option is borrow more. One option is what? Borrow more. Unless cash is surplus. Yeah. When you borrow and keep that, what to do with that cash? Are you understand what I am saying? Other option is reduce the equity. Are you understand what I am saying? How to reduce the equity? Go for the buyback and try to achieve a target capital structure. And also be used as a means to alter what? The capital structure of the company. Everybody following on? These are all the uses of a buyback. What seems to be a simple strategy has got so many motives behind it. Everybody following on? That is why whenever a company announces buyback in the market, entire market analyzes why it is going for a buyback. They see the reason for going for the buyback to understand the mood of the company behind the buyback move. Because dividend distribution, nobody asks why it is distributing dividend. It is having cash, distributing dividend, nothing more. But when a company goes for what? Buyback, there can be some scheme behind what? Scheme na what? Not bad, yeah, okay. Some reason behind what? Buyback. With the market is analyzed, they get more information about what? Company. Always share price about information na. Information can come only from what? Company's actions. Buyback is one of the actions that communicates information about the company to the general public. Are you following or not? So the last 2 points I'll dictate. Point number 4 or 5? Solliya. Point number 5, please. See, don't discount all these things. In examination, they ask question, advantage of buyback. The question is answered not. They ask for 4 marks. Yeah, you need not buy hard it from any place. The answer is here. Are you following? Now, next. Stop. Point number 4 or 5? Yeah? 5. Point. Buyback, please. Buyback may be used. Buyback may be used as an instrument. Buyback may be used as an instrument by the management. Buyback may be used as an instrument by the management to increase. Buyback may be used as an instrument by the management to increase their proportion of shareholding. Buyback may be used by management as an instrument of increasing their proportion of shareholding in the company, increasing their proportion of shareholding in the company, their proportion of shareholding in the company, and decreasing the proportion of activist shareholders, and decreasing the proportion of activist shareholders, and decreasing the proportion of activist shareholders. Through this, they can obtain freedom in decision making process. Through this, they can obtain freedom in decision making process. Through this, they can obtain freedom in decision making process. Last point. Point number 5 or 6? 6. Buyback can be used. Point number 6. Buyback can be used to alter. Buyback can be used to alter the company's capital structure. Buyback can be used to alter the company's capital structure. Buyback can be used to alter the company's capital structure. Okay. These are all the advantages of buyback. Dividend, the advantage is when the company shares are overvalued, It is not feasible for the company to invest in its own share. Okay, I will never invest in an overvalued share. Even though shareholder money is there, already is overvalued. If I believe it is overvalued, still buy back. Now, I'm making a wrong investment of shareholders' money. Everybody is or no? In that case, when the share is overvalued, naturally company will not go for the buyback. That is one of the thing. Okay. Number two, buyback reduces what? Market float. Opposite can be said, it reduces the public participation. Right or not? More number of shareholders is more prestige for the company. The public participation is what? Reduced. That is also another disadvantage of what? Buyback. But otherwise, dividend buyback are equally good is what we have discussed. Can I proceed or not? No. Next, let us do one more sum in this buyback before we wind up this chapter. Take the next question. I think it is question number 15. Okay, please. Stop talking. Nothing conceptual, computational problem. That's all. Famous problem, once asked in ISW exam as well as in what? CA exams. Okay, please. Stop talking. A limited. A limited. I cannot do auction. Yeah, I am going to read A limited third time. I don't know. No, please. Don't talk. Has a surplus cash or rupees 90 lakhs. Okay, please. And wants to distribute 30% of it to its shareholders. Please. The company decides to buy back the shares. The company estimates that its share price after repurchase is likely to be 10% above the buyback price. It can happen. Normally you said after buyback share price will not change. But I also gave you the other reasons now. Due to buyback supply may decrease and share price may what? Increase. This is what is happening here. The share price after buyback is going to be how much percent above? 10% above the buyback price. If the buyback route is taken. The number of shares outstanding at present are 10 lakhs and the current EPS is 3 rupees. You are required to determine the price at which the shares can be repurchased if the market capitalization of the company should be 200 lakhs after the buyback. The number of shares that can be repurchased. The impact of repurchase on the EPS, assuming that the net income is same, is the question. Can we start or not? Now, first of all, answer my question. Market capitalization is equal to what? Number of shares of the company into market price of the share. This is a simple meaning. Everywhere they use the word market capitalization. I already said to you before itself, right or not? So the word market capitalization means what? The number of shares of the company into what? Market price of the share. Respond yes or no? Now, this company is having a target. It is having what? Target. The target is after buyback. After what? Buyback. Its market cap should be how much? 200 lakhs. With this target only, it is going into the buyback scheme. Are you following now? Before buyback, the market cap might have been reduced less also. Are you following what I am saying? Now, they want to increase their company's value. They want to what? Increase their company value to how many lakhs? 200 lakhs. After the buyback is over. Respond yes or no. This is the target the company is keeping for venturing into the buyback. Are you following now? And next is, company believes that if they buy back at X rupees, if they buy back at how much rupees? Yeah? X rupees, the share price after buyback will continue to be X, will increase. Normally, it should be X. Normally, it should be what? X theoretically. Yes or no? But market sentiment, it may also what? Increase. The company believes that after buyback, the share price will not be the X rupees. It will become how much? 110% of X because the share is going to expect to increase by how much percent? 10%. Is the next detail given. Are you following or not? And at present, how much surplus cash is available? 90 lakhs. Are they going to distribute entire 90 lakhs? No. The company says 30% they are going to distribute. How many lakhs here? 27 lakhs is going to be distributed. And what is the current number of shares of the company? 10 lakh shares. After buyback, same 10 lakh reduce. How much you have to find out later. And today the EPS, how much rupees here? 3 rupees. Today the EPS 3 rupees, no. How many shares are there? 10 lakh. What are the earnings of the company? What is the company? 30 lakh. After buyback, next year, will the earning increase or decrease? Company's earnings 30 lakhs will increase or decrease? Same. The company remains what? Same. Because they are not distributing an asset, distributing only what? Surplus cash. The current income will be continued to be what? Earned in the future also. The company's earnings will remain same. What happens to EPS? Why it increases? The number of shares sharing the earnings has decreased. Everybody, are you following or not? Now the question is, you have to find out the buyback price, number of shares bought back, and also the EPS after the buyback has been made. If the question is asked for 6 marks. Everybody following or not? Now, let me do it, or let us do it together. Write down first. Question number, what is question number? 15. Question number 15. Step 1, buyback price. Step 1, buyback price. Step 1, buyback price. Can we start up? Right on. We know the buyback price, don't know. That's the first question now. Now, let buyback price be. I am going to purchase the shares at some price or not. Let buyback price be X. Let buyback price be X. Let buyback price be X. Can I proceed? Number of shares, number of buyback shares. Number of buyback shares. Stop and tell me how much money I am going to spend for buying back. 27 lakh. Every share I am going to buy back how much rupees? X rupees. So how many shares is going to be bought back here? 27 lakhs divided by X. This is suppose I am going to buy back at 100 rupees. What is the price? I am going to buy back at 100 rupees. How many shall I be buying back at? 27 lakhs divided by 100 and so on. So let the buyback share price be what? X. Now how many shares should be bought back? 27 lakhs divided by X. This number are you following or not? So write down number of buyback share is equal to 27 lakhs divided by X. 27 lakhs divided by X. Okay. I'll put the next line, but let me discuss and put it. Okay. See, now the company is having how many shares? 10 lakh shares. What is the current number of shares? 10 lakh. After buyback will be 10 lakh shares, more than that, less than that, less than that. So the number of shares bought back is 27 lakhs divided by X. 10 lakh shares minus 27 lakhs divided by X gives you the number of shares floating in the market after buyback. Yes or no? Okay. Tell me, what is market capitalization? Number of shares in the market into market price per share. Yes or no? So, I know the number of shares in the market after buyback is how much here? 10 lakh shares minus 27 lakhs divided by the number of shares in the market after the buyback. Accepted or not? Now, into the market price of the share after buyback will be same buyback price of X is expected to increase or expected to increase. Since the float has decreased, demand may be what? More. They expect to increase by how much percent? 10%. Into what market price of share? 1.10 X. Yes or no? Now, this is the number of shares post buyback. This is the market price of a share what? Post buyback. This market cap should be how much here? 200 lakh. Is what the question says. Are you following on that? Now, if I what I say? Compute for X, I get the buyback price. Everybody, are you comfortable or not? Now, let's go for the calculation now. Right on. Third, market capitalization is equal to market capitalization is equal to 10 lakhs minus market capitalization is equal to 10 lakhs minus 27 lakhs by X. Market capitalization is equal to 10 lakhs minus 27 lakhs by X into 1.10 X. 10 lakhs minus 27 lakhs by X into 1.10 X is equal to how many lakhs? 200 lakhs. Is equal to 200 lakhs. You believe me? You can do it on your home. Yes or no? If you solve for X, X is equal to 20.88. X is equal to rupees 20.88. X is equal to rupees 20.88. What is 20.88? The price that is the company has offered to buy back. 20.88. Can you proceed or not? Next. Buyback price over. Step 2, number of shares brought back. Number of shares repurchased. Number of shares repurchased. Number of shares repurchased. Underline that. Number of shares repurchased is equal to number of shares repurchased is equal to 27 lakhs. 27 lakhs divided by 20.88. 27 lakhs divided by 20.88 is equal to 1,29,310 shares. Is equal to 1,29,310 shares. 129,310 shares. Next, step 3, EPS after repurchase. Step 3, EPS after repurchase. Earnings per share after repurchase. EPS after repurchase. Tell me, what is EPS after repurchase? 30 lakhs. Why 30 lakhs did not change? Earnings continues to be same after buyback because no project is abandoned. Yes or no? 30 lakhs divided by 8,70,690. I think I understand this. How I got 8,70,690? 10 lakhs minus the number of shares brought back. Sorry, bought back. 30 lakhs divided by 8,70,690 is equal to rupees 3.45. Is equal to 3.45. Very simple. They managed to increase a 3 rupees EPS to what? 3.45. Okay. So it's another advantage of buyback, increasing the EPS. Now, with this, we have completed this particular concept called as share buyback or share repurchase. Okay. Now, Linter's model, I'll come back and do it. It's a small issue. Now, I want to start with the new chapter, portfolio management. That's a very incidental area. With this, we completed what? Dividend policy.